Welcome to your 20s. You're stepping into your first real job, but right now, your most valuable asset is passing faster than you realize: time. Today, we are going to map out an exact, personalized first investment portfolio. You don't need a massive bank account, and you don't need to be a financial expert to execute this plan. Before we begin, grab a piece of paper, write down your current age, and then write down a strict monthly budget that you can commit to investing without fail. Even if it is a very small number, write it down. Transforming the overwhelming idea of investing into a simple math equation removes the friction of getting started, and getting started is the highest hurdle for any young earner. Step 1 is establishing your target. We have to look at the mathematics of compounding to see exactly why starting today matters. Let's plug in a standard baseline. Assume you are 21 years old. You commit to investing 10,000 rupees every single month for 39 years until you retire at 60. And let's assume a conservative 10% annual return. This calculator shows how these inputs stack up. Over 39 years, your monthly deposits grow, reaching 5.76 crore rupees. Watch what happens if you delay. Starting at age 40 instead of 21, your final amount drops to just 76 lakhs. That gap proves a critical rule. Capital is secondary. Time is the single most powerful variable in long-term wealth generation, which makes taking immediate action not just a suggestion, but an absolute requirement. The biggest psychological barrier keeping young earners out of the market is the fear of timing. Nobody wants to invest their first paycheck right before a crash. It is a valid fear. If you started investing in 2008, you watch the market collapse immediately after you put your money in. This chart shows the Nifty's drop in 2008, followed by a long climb to 2020. If you panicked and stopped, you locked in losses. But buying steadily through the dip acquires units at lower prices. This automatically averages out your overall risk. Market crashes are not reasons to panic. For a disciplined, long-term investor, they are periods of cheaper asset accumulation. Step 2 is allocation. Now that you're starting, you must know exactly how to divide your budget between high-growth assets and stable safety nets. There's a strict mathematical formula. Take 100 and subtract your age. If you are 25, the result is 75. That number is the exact percentage for equity, like stocks. The remaining 25% is assigned to debt, for stable, low-risk assets. When filling your equity bucket, do not follow random tips from friends. Do not invest in single stocks without researching them, and avoid the herd mentality of buying something just because everyone else is. Relying on this rigid mathematical rule protects you from emotional decisions. It guarantees a risk profile that is perfectly aligned with your age. Step 3 is deployment. You need a way to fill that 75% equity slice without spending hours researching individual companies. The safest entry point is to invest in broad market themes or index funds. ETFs, or small cases, allow you to buy a basket of top companies all at once. Look at this top 100 small case dashboard. It bundles companies by market cap, showing a 16.9% historical growth rate, requiring just 554 rupees to start. A requirement of less than 600 rupees completely eliminates the excuse of not having enough money to start investing. Buying a bundled index means you capture the upside of broad economic growth without needing any stock market expertise. Step 4 brings us back to balance. We need to secure the remaining 25% of your budget in stable debt vehicles. The Public Provident Fund, or PPF, is the optimal foundational choice here. You can start with a minimum monthly contribution of only 500 rupees. This timeline shows the strict 15-year lock-in period for a PPF. If you open it at age 21, your major lock-in is completely over by age 36, giving you access to tax-free returns at a current rate of 7.1%. You can split the rest of this debt allocation into gold funds. Historically, gold moves in the opposite direction of equities, providing an extra layer of hedging. Your entire debt bucket operates as the portfolio's shock absorber. Whenever the stock market dips, your baseline wealth remains protected. These 3 charts show how your individual buckets combine to form a complete structured portfolio. Whether you prefer a low-risk, moderate, or high-risk allocation, the mechanics of splitting equity and debt remain the same. If you want a single-click solution, options like the all-weather investing small case automatically bundle your equity, debt, and gold allocations together in one place. Your instructions for today are simple. Calculate your exact 100 minus age ratio. Decide your monthly amount and initiate your first 500 rupee transfer by the end of the week. Generational wealth is not built on hot stock tips. It is the result of disciplined, methodical execution of a systematic plan, started as early as humanly possible.